All right. Today is Thursday, January 5th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. We start with the House fiasco. We're still waiting for a Speaker of the House. McCarthy so far lost the 11th vote in a row. And of course, a lot of folks are attributing the volatility in the market that we're seeing right now on what's going on in the House. I don't understand why. I don't understand why the market cares about who the Speaker of the House is. Whether it's McCarthy, McDonald's, who cares? But I guess until we have a solid second in line, at least we know who's going to be second in line, because the guy in charge could drop any moment, and then the vice president, well, that's another disaster. And who takes over in case both of them are not available? And I guess that's causing market volatility. Who knows? But today we got perhaps an important update from the Fed, this time around they say he's one of the most hawkish Fed members. In my opinion, he's not. He was the king of the bulls back a couple of years ago, and then he became bearish. I would say he is the most outlandish Fed member because he has the tendency of using certain substances and then issuing blunt statements. And of course, we're talking about St. Louis Fed President James Bullard, our favorite Fed president of all time. And today he came out and said that inflation will go down. As a matter of fact, 2023 will be a year of disinflation. And he also added that perhaps the Fed funds rate is getting closer and closer to being high enough to bring inflation down. In other words, close enough to the restrictive rate, quote unquote. So all of this is, dovish, bullish for the market. You got one of the most hawkish Fed members saying, hey, inflation is going to go down. Oh, by the way, the Fed funds rate is high enough and maybe we're going to pause really soon. So why didn't the market move higher? Because all of this is good talk. Perhaps because Mr. Bullard also said that he need rates higher for longer to keep pressure on prices. So he said that perhaps interest rates are high enough, but he also says that they need interest rates to be higher for longer. Okay. And while he said that inflation will go down in 2023, he also added that inflation likely to ease slower than market expects. In other words, Mr. Bullard said that interest rates could go higher, lower, or stay the same. He also said that inflation could go higher, lower, or stay the same. And without a clear message by Bullard, he's all over the place. The market couldn't rally, couldn't find the footing or the excuse to move higher. Now, we have an important topic today because forget about the Fed, forget about McCarthy and the House. What really matters at the end of the day is what corporations are doing. What they're doing right now is extremely alarming. We talked about Salesforce last night, laying off 8,000 employees, about 10% of their staff. And of course, as I was recording the video, we got the breaking news that Amazon is going to lay off 18,000 employees. We're just getting started here, baby. With that out of the way, let's move on to the main topic of tonight's program. And here it is, in focus tonight. Grab the popcorn because we have an economic collapse on our hand. And I know what you're going to say, hey Maverick, what's up with being a perma bear? Have you noticed that you've been saying this for about 2 years now? Every single time I'm proven to be right. For example, go back to the video that I made, which was the 2022 year preview. I produced this video about, December 29th, and the title is The Everything Bubble Will Crash in 2022. In this video, and this is really important, I highly recommend that you go back and watch this video because we have economic indicators, reliable ones, they've been working for years. But during the mania in 2020, 2021, the naysayers, in reality, the dumb money who are chasing the mania, when you remind them about, in this case, I use the Buffett indicator, and I would say, hey, look at the Buffett indicator. It is saying that we're going to have a crash. We're going to have an economic reckoning, meaning a readjustment. This is a bubble. It's going to blow up, and we're going to have a recession. And folks would say, well, where is the recession? All I see is economic boom, stimmies all over the place, people buying stuff, jobs plentiful, yada, yada, yada. And the market continues to go higher and higher and higher, despite your boomer Buffett indicator. All of this stuff is old. But in that video, I told you that certain indicators need a complementary piece of data as an activator for the indicator to work out. In plain English, if you watch this video, the Buffett indicator was spot on. It was not outdated. It was not wrong at all. It was actually a clear and solid warning signal. But it needed something else to happen. It needed a complementary piece of data to take place before the Buffett indicator is activated. And this piece of data is interest rates to move higher. Well, in 2022, we got that. And therefore, the Buffett indicator played out perfectly and the market went down big. And guess what? Every time we have a market bubble, they say, oh, Warren Buffett is outdated, he's old, he's a dinosaur. They said this back in the .com and back in the last bubble. And every single time, Warren Buffett is proven to be right. That value investing, looking at the fundamentals, is what really works in the long run. Meanwhile, chasing manias and bubbles with no fundamentals is an errand for the fools. And the evidence for that, if we look at the performance of Berkshire Hathaway, for example, the 1 year performance, we see that the market is all in all down. You got Amazon down 50%, Google down 40%, Apple, Microsoft down over 30%, Tesla down over 70%, while Berkshire Hathaway is positive. Not by a lot, but it is positive. In other words, once again, Warren Buffett is proven right. Now, I have criticism for Mr. Buffett because he's overweight Apple. I think they should get rid of a lot of Apple. If he did that last year, Berkshire Hathaway would have outperformed by a lot. It would have been positive by 10-20%. But in any case, when we talk about 2023, I have one indicator for you that is missing the key. This indicator says that we're going to have an economic collapse and a recession, but it needs a key. What am I talking about? The indicator I'm looking at is consumer credit, which is now reading at all-time high. In other words, the consumer is using more debt than ever before, be it credit cards, be it auto loans, be it mortgages, be it everything, doesn't matter. Yet we're not seeing the collapse yet. We're not seeing mass delinquencies yet. So what is the key that we're looking for here to unlock this piece of data, this indicator, and make it active? Keep that thought in mind, because we're going to revisit it in a minute. But let's add more color to this indicator. Credit card balances jumped 15%. This is the highest annual leap in 20 years as Americans fall deeper in debt. Now, it's one thing when debt was cheap with interest rates at zero, but now with interest rates moving higher, the cost of debt is moving significantly higher in a rapid scale. Credit card rates, for example, are heading 4-decade high this year. Once again, 4-decade high. That is 40 years, just in case. Meanwhile, Americans continue to swipe those credit cards up and down, up and down, up and down with no mercy at all. And not only that, they're also opening more and more and more credit cards, more than ever before. Now, what could go wrong here? When you have consumers racking up debt like never before, while interest rates continue to move higher and higher and higher. It's a recipe for a disaster. Out of all credit card accounts, 40% say that they're carrying a balance at some point, meaning they're not paying their credit cards. They carry on the balance over and over. Matter of fact, among all active credit cards, 53%, the majority of Americans, are carrying this balance at some point at least. And as you can see, looking at the major credit card issuers, Bank of America, Citi, Discovery, doesn't matter, we're seeing the rate of delinquencies moving slightly higher year over year. Not by a lot, nothing major as we've seen back in the GFC, but this is starting to get really, really alarming. Besides credit card debt, we also have the buy now, pay later phenomenon. And a lot of folks thought that they can use this to buy appliances, phones, electronics they cannot really afford. And guess what? This debt continues to rack up. The interest rate is going to continue to move higher. And what we see here is major mistakes, specifically by the Gen Zers, who overused buy now, pay later, and now they're getting wrecked and they cannot pay their debt. So on one hand, you have these companies Affirm, Afterpay, they're holding the bag because the consumer is not going to pay them back. And you also have a consumer who will be damaged credit-wise, etc. These guys are just starting life, the Gen Zers, and they're already starting life on the wrong foot. And with inflation rising higher, sometimes you have no other choice but to use buy now, pay later. In a desperate sign among Americans, we have eat now, pay later. Americans are now using these services to pay for grocery expenses because they can no longer afford them. Food costs are moving significantly higher, out of whack. We have here, in the richest country in the world, that is, by the way, spending what, $850 billion in defense spending, quote unquote, and blowing up about $100 billion plus in Ukraine. Yet the people of this country are going into debt to eat, to buy stuff at the grocery store. How beautiful. And now we're seeing the delinquencies because they continue to use debt over and over and over again. At some point, it racks up. Even if you have a salary, even if you have a job, it's going to get too much to catch up with. And therefore, we're seeing delinquencies across the board surging to 13-year high. And when we look at the disaster in the auto loan market, specifically for subprime auto loans, the delinquencies are rising higher and higher and higher at a rapid scale. So you have folks who took insane auto loans to buy used cars. In certain cases, as we've covered before in this program, paying $1,000 plus a month in auto loan payments for a used car. And the rate continues to move higher while the value of the used car continues to collapse. Beautiful combination. But so far, so good. We're not seeing things blowing up, even though consumer debt is out of whack, even though you look at all of these indicators, and all what you can think about is something is going to blow up here. Something is going to go wrong here. So we go back to the same conversation that we started this segment with. What is the key to unlock this piece of data of consumer debt shooting up significantly higher and causing a recession? The missing piece is layoffs. If you rack up all of this debt and suddenly you lose your job, now what are you going to do? Because rates continue to move higher and you're going to be dug deeper and deeper into this hole. So all of a sudden now you have to get rid of your positions. Get rid of the car you can no longer afford. Get rid of the home you can no longer afford. Get rid of appliances and stuff you can no longer afford because you lost your job, you lost your income. And oh, by the way, you're now delinquent in your accounts. And at some point you might have to file for bankruptcy. And if you see this phenomenon being replicated at a mass scale, you have a recipe for an economic collapse, a recipe for a deep recession. And unfortunately, the key to unlocking this data and enabling this severe recession is happening right now as we speak. We got the news yesterday that Salesforce is laying off 10% of its workforce. And now we're getting the news that Amazon is getting rid of 18,000 jobs, the biggest round of layoffs in the company's history. Take a look.
We now have confirmation, Rich, from Amazon, a memo from the CEO to staff, that they will be cutting more than 18,000 jobs, as mentioned, much more than previously expected going into the end of the year. There was an indication that about 10,000 jobs would be cut, but this far more than expected, and therefore indicating to many that this is a latest sign the tech slump deepening. The cuts, again, we're told in the memo from the CEO, will be mainly in the corporate ranks. Retail division and human resources. We're also told that affected staffers will be taken aside beginning January 18th, and various issues such as severance and assistance in finding other jobs will then be discussed. The CEO, Andy Jaffe, also said in a memo that this is part of the company's annual planning process. Quote, Amazon has weathered uncertain and difficult economies in the past. He said they will continue to do so. And quote, these changes will help it pursue our long-term opportunities with a stronger cost structure. Cost cutting really the name of the game for so many companies as we enter 2023. This, the biggest tech cuts we've seen in Silicon Valley.
And by the way, if Amazon wants to reduce costs and expenses, how about you start by your own CEO, Andy Jassy, whose compensation exceeds $200 million, the equivalent of over 6,000 times what the regular employee at Amazon receives. So if you want to cut expenses, start with cutting the compensation of the CEO. But of course, this is not going to happen. Yesterday, we talked about the Ohana bullshit by Mark Benioff. He's not going to cut his salary. He's not going to cut his fancy houses and compensation packages. And the same goes with Andrew Jassy and the rest of them. They're not going to cut their pay. They're not going to cut their bonuses. They're going to cut your job. They're coming for your ass. You pay the price either way. And oh, by the way, since we're talking about corporations cutting expenses, if you happen to work in these tech companies with the fluffed up valuations and the money coming from all over the place, well, the money's no longer coming. So the ping pong table, the arcade games, the yoga studio, the massage therapists, all of that is being cut off. Even the coffee machine is gone, at least in Goldman Sachs. So if you thought that the American worker is dissatisfied before, oh boy, it's going to get a lot worse. Stay in your desk, keep working, and most importantly, keep your mouth shut. No more coffee. Coffee is for closers. And in certain companies, it's even worse. In Twitter, for example, the CEO, Reverend Elon Musk, is now asking employees to bring their own toilet paper. And oh, by the way, there are no janitors anymore. So you make a mess in the bathroom, that's your problem. And by the way, when they do these layoffs, Back in the day, even during the GFC, they will send somebody, sit you down, say, hey, we thank you for your years of service, but the company is going through a transition right now, and we have to get rid of certain jobs. And unfortunately, you were picked among these jobs that we have to cut. Here's a package for you to lead you through the transition, blah, 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 all that bullshit. Now, they don't even do that. You find out that you lost your job via an email, and if you're lucky, you might get a Zoom call. That's how inhuman this process has become. So again, the workers of this country will become even more overworked and more dissatisfied. Very bad combination. And I know what you're going to say. You're going to say, hey, Maverick, I think you're just looking at the half-empty part of the glass. You're looking at the layoffs by Meta, by Salesforce, by Amazon, but you're not talking about the jobs report, for example. Hold your horses, we did talk about it before my hiatus. The last video that I produced was exposing the government who got caught cooking the data and overestimating jobs by over 1 million. So when you talk about, oh, the jobs market is great, is it really? Or are they cooking the data to serve the regime and make it look better? But I know what you're going to say now. Okay, Maverick, that's the government data. That's cooked, we know that. But what you got to say about the ADP employment report that we got today? This is a private company about private payrolls. They have no interest in making the regime look better. Maybe, but maybe their methodology is not that good. Because remember, the ADP had to shut down for a little bit, revise the methodology, and come back. And I think they're overestimating the jobs created in this country. I think the JOLTS, the job openings data, for example, is a fugazi. You have all of these job openings from 2020 still on, still posted, and still counted. For example, today's data from the ADP report showed that small businesses in this country employing 1 to 19 employees created about 65,000 jobs last month. Small businesses with 20 to 50 employees created 130,000 jobs. Mid-sized businesses, 50 to 150 employees, gained 159,000 jobs, while companies with 250 to 500 employees gained 32,000 jobs. And lastly, large businesses lost 151,000 jobs. So you could say, hey, Maverick, maybe we're seeing Amazon, Meta, etc. laying off employees, but small businesses are doing good. Hold your horses. The devil is always in the details. When we look at the goods sector of the economy, for example, natural resources and mining down 14,000 jobs last month, manufacturing down 5,000 jobs last month. On the other hand, construction gained 41,000 jobs. Do you see any construction going on here? I don't know, maybe the chip plants from the so-called CHIP Act, where they stole money from the taxpayer to build factories for companies making billions of dollars in profits? Maybe, perhaps. When we look at the services sector of the economy, trade, transportation, and utilities lost 24,000 jobs. Financial services lost 12,000 jobs, yet the rest gained significant amount of jobs led by, once again, leisure and hospitality, with about 123,000 jobs created last month. Now, it's up to you. Do you want to believe this data or not? I believe what's going on the ground right now. When you hear companies laying off employees by the thousands, I think this is the trend here. And we're going to see it expanding as we move ahead in 2023. And when you talk about small businesses creating jobs, at least according to the ADP, I'm not seeing that in the ground. And a lot of indicators are disagreeing with the ADP. For example, when small business owners themselves are asked what's going on with the employment picture, they're actually showing declines in hiring for the straight third month. U.S. small business owners dialed back hiring plans for a third straight month in December, and the smallest shares had unfilled positions as firms continued to face higher labor costs and a lack of qualified candidates. A net 17% of small companies planned to add workers, down 1 percentage point from the prior month, and the fewest in almost 2 years, according to the data out Thursday from the National Federation of Independent Businesses. Some 41% of firms had open positions they could not fill, down 3 points from November, while openings have fallen since matching the record of 51% last year. They are still historically elevated. Perhaps this is the most important part when we talk about inflation. Some 44% of small business owners boosted compensation, so wage inflation moving higher. If you think this is over, think again. An increase from a month earlier, and a share that remains well above pre-pandemic levels. Labor quality was cited as a top labor market concern by 23% of small firms, up 2 points from November. So again, you can use whatever piece of data you want, But if you have an ounce of a brain left, you know that with the Fed tightening the monetary policy and increasing rates this rapidly, and with stock valuations getting crushed, you put two and two together, it's just a matter of time before we see the mass layoffs happening in the economy. Not just by large enterprises, but also by small and medium businesses. Because think about it, when you have these thousands of employees getting laid off by Amazon, Adobe, Salesforce, Meta, it doesn't matter which company is doing the layoffs. These folks consume in the economy. They go to small and medium businesses, restaurants, etc. They consume. If they lose their income, they stop spending in the economy. They stop spending in medium and small businesses. And little by little, we see the layoffs, the tsunami of layoffs, moving down from large businesses all the way down to small businesses, and then game over. And then we start talking about all of these people who lost their jobs, yet they have mortgages they cannot afford, they have rents they cannot afford, they have auto loans they cannot afford, they're delinquent on their credit card debt, they can no longer pay their debt from the buy now, pay later phenomenon. And then what happens? The answer is kaboom, a recession and an economic collapse. And once again, with this lovely bedtime story out of the way, let's move on to cover the stock market information for you. And we begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 339.69 points, or down almost 1%. The Nasdaq leading the pack to the downside by 153.52 points, or a decline of almost 1.5%. The S&P also in the red, down by 44.87 points, or a decline of 1.16%. When we look at the sector's performances for the day, down across the board, all in the red, shame on all of them, with exception of energy coming up at number 1, capturing the gold, silver, and the bronze. So is the profit taking over in energy? Too soon to say, but we have a consistent theme so far this year, in which technology continues to lag over and over and over again. But folks, I've been saying this at least in the last couple of days. So far this year, we have a consolidation. We have a market in consolidation, I should say. And we have different themes pretty much every single day. One day, energy is down, leading the pack to the downside. And then like today, for example, we get energy leading the pack to the upside. So for now, in a market that is confused in trying to find its identity and its direction for the year, it is really dangerous to make substantial moves one way or the other, long or short. So for now, your boy is just doing day trades, in, out, hello, goodbye. No major assignment of any positions here because it could go either way. More on that in the charts analysis. But before we do that, what about the advance to decline ratios? The NYSE, 33% advancing versus 66% declining. The Nasdaq, 40% advancing versus 58% declining. Now, the breadth in the Nasdaq was not really that bad, but the big names are down, Microsoft, Amazon, etc. And that makes the picture look worse than it really is. On to commodities. Today, we're seeing the opposite phenomenon that we've seen yesterday. Today, we got the Aussie down, the Kiwi down, the British pound down, even the yen down, along with the euro, and therefore the dollar, the US dollar, blasted higher with gains of almost 1%. So we have some commodities under pressure here, but the theme is not clear. For example, we have seen that gold and the dollar been rallying together, at least in the last couple of days. Now we're seeing the dollar up, gold down, but copper up by 2%. Confusing, mixed signals all over the place. And therefore I say any major positions open right now, big mistake. Let the confusion settle, and it's going to settle soon. We're going to know the direction one way or the other. For example, when we look at energy commodities, yesterday natural gas was up, crude was down. Today we're seeing the opposite. Crude is up, rebounding by about 1.5% apiece for the WTI and Brent, yet natural gas down big, losing almost 9.5% of its value. When we talk about softs, mixed picture across the board, coffee, lumber, sugar down, yet we have cocoa, cotton, and OJ blasting higher. Cotton scoring gains of over 3% for the day. Likewise, when we look at meats and grains down for the most part, you can look at this as good news re-inflation as we see food inflation moving down. But the reason behind that is the dollar moving higher, which is not good for corporate earnings. So it is a double-edged sword here. You lose either way. And if the dollar goes down to relieve corporate margins, guess what's going to happen? Commodities prices, including grains, will move higher again. So we are now, unfortunately, in a lose-lose situation either way. When we move on to the options market, the big casino, what do we see here? The notable theme is the volume is cooling down. Now, this could be looked at as a bullish indicator because The volume has been rising higher as the market goes down. In other words, we've been seeing an increase in volume in puts. But now that the volume is moving down, sure, the ratio might be still favoring puts, but the fact that the overall volume is down is perhaps a good sign for the bulls because it says that we're seeing the climax of selling. This is one of the few pieces of data that the bulls can use as a source of hope because there ain't that many. In any case, the hottest stable by far remains Tesla, the souffle, with about 2.6 million contracts traded today. About 55% of those were puts. And the number 2, Apple, with around 1.5 million contracts traded today. About 56% of those were puts. Amazon at number 3, with around 800,000 contracts traded today. About 56% of those were puts. Of course, the options volume for Microsoft is moving higher as we see Microsoft moving down. I would say look at the IV rank between Apple and Microsoft. Microsoft has further downside to go because the volatility could increase even more. Yet when it comes to Apple, we're kind of topping off here when it comes to the implied volatility. In other words, we're looking for a rebound in Apple. If you have a choice between buying call options for either Apple or Microsoft, I would go with Apple at this point. And of course, we're talking about short term. Long term, they're all going down. We also see the implied volatility and the volume rising higher for names such as the ticker SI, Silvergate Capital. A lot of you have been asking me about this, and a lot of you have been saying, hey, should I sell puts? Should I sell calls? Folks, be extremely careful here when you sell puts or calls in a volatile name like this. It was up double digits yesterday, now it's down by over 42% today. And my hunch tomorrow, we could see the name blasting higher again. So if you sell puts and these puts expire in the money, you're now obligated to buy perhaps thousands, if not millions of dollars worth of shares in this trash, which you know it's going to go down bankrupt. If you sell upside calls and it happens, your luck, of course, the name closes in the money by the end of the week or by the expiration date, now you're obligated to buy shares of SI and sell them perhaps at a higher price and eat a massive bag. So please, when it comes to these highly volatile names, do not sell puts, do not sell calls. If you want to play it one way or the other, buy naked puts, naked calls, use spreads, and don't invest a lot of money. These are wild shots. If they hit, they hit. If they don't, they don't. And I did buy call options for SI today. I'll show you that in a minute. And speaking of, here it is, the unusual activities that took place in the options market today. We start with the ticker CZR, Caesar's Palace, or Caesar's Entertainment, whatever. Somebody sees the name moving higher and they bought the $50 calls for the expiration date, February 17th, with expectations that CZR could blast higher and gain more than 18% by then. They paid around $1 a piece to enter this trade, all in all spending around $1.7 million. And here it is, the ticker SI. And this is exactly how I did it. I bought the spread, I bought the $14 calls, and I sold the 15.5, as you can see right here, all for the expiration date Jan 20. And me, paid about $1 a piece for the $14 calls, and we received about 60 cents a piece. And that is credit from selling the 15.5 calls. All in all, the entry cost is reduced down to 40 cents a piece, and the maximum gain from this trade is $1.5. So the maximum gain from this trade is capped at around 200%. I'm not being greedy here. I'm not investing in an insane amount of money. It's a wild shot. If it happens, it happens. If it doesn't, it doesn't. And then we have another trade that I followed here, the ticker BOIL, BOIL. This is the leverage index for natural gas, meaning it rises higher by 3 times what natural gas scores in a single day. And then it resets. In other words, it is a bullish bet that natural gas will pop higher. It was an ugly day for natural gas today, but somebody sees a rebound coming, and I do agree, and this is why I did join this trade, and it is for the $15 calls for the expiration date, February 17th, with expectations that BOIL could move higher and gain more than 19.5% by then. And we paid about $2.25 a piece to enter this trade, all in all, spending around $1 million. And then what about the ticker GE for General Electric? Usually a trash name, but it has been outperforming so far year to date. So is it the theme for the year that GE is going to be the outperformer? Perhaps. And this is why somebody bought the 75 calls for the expiration date, March 17th, with expectations that the name could move higher and gain more than 5% by then. They paid around $3 a piece to enter this trade, all in all spending around $2.3 million. And last but not least, what about the ticker QQQ, the NASDAQ? What's going on here? Somebody see it going down and they bought the 240 246 puts for the expiration date February 17th, with expectations that the Qs could move down and lose more than 6% of its value by then. They paid around $4.14 a piece to enter this trade, all in all spending around $2.8 million. And then what about the heat map analysis? What do we see here? Red across the board, weakness across the board with few exceptions. Number one, the rebound in energy. And again, is the selling over? Is the profit taking over? We need to see consistency here because while oil prices were higher, the refineries were doing pretty good. Marathon, Valero, I have both. Both are up big for the day, but natural gas producers are down big. And then we have another outlier in GE. We talked about that. In healthcare, we have Merck. Merck continues to be the hottest name by far, even though it is usually a boring name. And then we have some of the old school communication services, T-Mobile, Verizon. These are also moving higher. And of course, in food packaging, I've been talking about this name for a while now, Conagra. That is up big for the day. And then we have in metals, with copper prices blasting higher today, of course, the ticker FCX, Freeport-McMoran, moving higher. Now, the underperformers, the obvious, the big caps, Tesla, Amazon, Google, Microsoft, Apple, chips are down big, software down big, and with rates moving higher, real estate and utilities moving down. Now, the notable loser for the year so far is UNH, United Health. I have a trade for you, and it's important that we look at this name since we're talking about layoffs. Companies will have less people to insure, and therefore, not good news for UNH. We'll talk more about it in the charts analysis, but before we do that, how about some corporate news for you? You might have noticed that Microsoft is down 2 days in a row, big time, and when it rains, it pours for Microsoft. On one hand, we have notable weakness in software, and the assumption is Azure will not be an exception, and therefore we got the downgrade from UBS yesterday, and that added a lot of pressure on Microsoft. Today it's down again. We have news that Microsoft workers are forming the first union. Again, not good news for Microsoft. And then we have news from the ticker LUV Southwest, which I'm shorting by the way, and now the company suffered major reputational damage, and they're attempting to fix all of that. Of course, they suck at everything, but most importantly at being considerate. I mean, look at this lady in the picture. She's looking at the graveyard of bags. And she's like, holy how am I going to find my bag here? And of course, Southwest sent me this email and they say, dear valued Southwest customer, look, you want to repair your reputational damage? Make it a little personal. Put my name there. Dear so-and-so. Don't send a generic message to everybody because you're not making consumers feel special after you screwed them. But the good news is they're giving me at least 25,000 rapid, reward bonus points or whatever. Look, I'm not pissed off because my experience pales in comparison with a lot of other folks who missed their Christmases, missed seeing their families, missed their weddings, missed jobs interviews, etc., etc. This is a major reputational blunder, and Southwest has to do a lot better. Make it a little personal for the love of God. Talk to consumers using their names. And then we have news for the WWE. After hours, shares are blasting higher last time I checked by 10%. And the reason is Vince McMahon is making a comeback. But he says he's only making a comeback to sell the company. Now, let me tell you something. If you know anything about Vince, he's not coming back to sell the company. That is the excuse he's giving everybody to come back. He's going to come back and he's going to stay. This is just the excuse he's using. We're going to sell the company. He's not going to sell the company. This stock has been doing pretty good. The company is rolling in cash. Why would you sell the company right now? But perhaps a company that needs saving is Bed Bath & Beyond. The meme stock mania comes down crashing. And now we have the first casualty in the bankruptcy path, Bed Bath & Beyond. Soon enough, GameStop and AMC, they're all going to go down. Bed Bath & Beyond is perhaps going to go down to zero, declaring bankruptcy, and they're going to need a lot of restructuring here. And where's Ryan Cohen, by the way? Oh yeah. He cashed out. So your cult leader left you holding the bag. Meanwhile, he cashed out. Do you realize how stupid you guys are? The apes and the likes? I mean, you started this whole thing to stick it to the man. Well, here's the man. Apparently, the man is doing better than ever before. Record revenues for Citadel. So this whole stupidity of sticking it to the man? Well, we now know where the sticking went instead. Moving on to the heat map for the ETFs. We see a sea of red here across the board with few exceptions. Massive down days for chips, for example, for real estate ETFs, the IYR, VNQ down big, even regional banks, the KRE down big. But what is working today? The underperformer for the last 2 days, the XLE, XOP, OIH, all outperforming today. And in international, we're seeing the opposite picture in the last 2 days, from the last 2 days, I should say, where we've seen Brazil, the EWZ, down big, while Chinese, emerging markets, developed markets, European markets moving higher. Today, we're seeing the opposite. The EWZ is up by almost 3.5%, the rest are down. So we have conflicting themes right here. The market is trying to find a footing one way or the other. The market remains in a conflict, looking for a theme for this year. Why not wait till the market makes up its mind? Because you could say, look, China is the way to go. Let's buy the FXI. You do that and the next day you're down. You might say, hey, Brazil should be a short this year. You short Brazil EWZ and it pops higher right in your face the next day. And the same goes whether we're talking about energy ETFs, banks ETFs, real estate ETFs, value, doesn't matter. For now, we don't have any clarity to make major moves yet. Keyword, yet. So let's look at the charts, and we begin with SPY, the S&P 500 30 minutes chart. What do we see here? The chart is still holding the pattern of higher lows. Yes, it did close below the important number of 379.5, but not by a lot. And it continues to maintain the trend, at least for now. So I caution a lot of the bears who are looking at the action, at least today, and they say, okay, I guess this is clear. Down we go. We have to go all in, buying puts or shorting altogether. Be careful here because we don't have any decisive break one way or the other, not yet at least. For all you know, you short today because the Dow is down, Tesla down, whatever down, doesn't matter. And you short the S&P, you short the Qs, next day pops higher again. We need to see decisive breaks with confirmations before we say that the chart's going to go one way or the other. And to make it clear for you, here's the daily chart for the continuous contract for the S&P. Did anything change today? The answer is not quite. It remains in consolidation pattern, going back and forth at around 3,855. And sure, the overall pattern is of a bear flag pattern. And for all we know, it could play out and down we go. But it's not clear right now. You cannot really bet on it. With that being said, did today do any damage for the bullish outlook that says this is finding a footing at around an important support and higher we go once the buyers start to show up? Yes, there is a lot of damage today because the RSI went down. The MACD indicator, most importantly, if we blow it up a little bit, you can see it clearer here. The destination was for the MACD to cross, producing green impressions in the histogram and a confirmation that the bear flag is not going to play out and higher we go in a retracement to the next resistance. But it curved a little bit to the downside today. And if this continues and we see the columns in the histogram of the MACD, the red columns, getting a little longer instead of shorter, we see this curling down, it is an indicator that the bear flag is going to play out in the most vicious fashion. And if that is the case, we'll be looking all the way down at 3,600 as support. What about the Qs? 30 minutes chart, what do we see here? No update. Nothing changed today at all. The chart remains pretty much within range. Support 261.69. Yes, the Qs did close by a notch below this number, but it is not a decisive or a conclusive closing yet. If we closed at 260, for example, we would have said, okay, the support is now gone. But with this, you cannot really bet on it, although it is, once again, a bear flag consolidation pattern. And if it does play out, and the support of 261.69 is gone, we'll be looking down at filling the gap of 260. So if we close at 260, you're still going to have an open mind that this could rebound higher. But a close below 260 is what the bears are looking for to see a decisive pattern, a decisive signal that down we go in a big way in the Qs. Because here's the daily chart for the continuous contract for the NASDAQ. Again, it's going back and forth in a retest of the so-called June bottom, 11,058.5. It was a down day today. The RSI is worsening. The MACD is worsening. But can you bet on it that this is done and it's over and the bulls are dead and down we go? Too early to say, too risky to make that bet in a big way. To be conservative, we need to see the next support at 10,485 gone as support, and then we're talking. And by the way, you shouldn't have FOMO about it because there is going to be plenty of meat in the bone to chew on if the support of 10,485 is gone for good. The IWM 30 minutes chart for the Russell 2000, what do we see here? Yesterday was a positive closing. It was pretty good, above the support of 174.22. But now we're back below it again, yet all in all, within range. Now, you can look at this as a bear flag pattern and say, hey, down we go to the next support of 168.90. But we do have a bunch of gaps to close before we do that, it's too early to say right now if the chart is still within the consolidation pattern. It did not break its consolidation pattern, has been on since December. Who's to say that the chart's not going down, regathering some more energy, some more buyers waiting on the sidelines, and then it finds enough support to move above 174.22 again. Therefore, I say it is too premature to make major bets one way or the other. On to the dollar, a daily chart. What do we see here? Continues to pop higher. We're finally seeing the energy from the consolidation being released, and the dollar continues to pop higher. And there's plenty of room for the dollar to move higher based on the RSI, the MACD indicators. But we have to move the resistance down a bit because this is not the most immediate one. And if we do that, we have resistance at around 105.8. And then above that, we have 106 and then 107.5, but we'll take it one day at a time. And of course, in the last few days, it has been confusing. Why is the dollar and gold moving higher together? I told you that one of these two is lying, and my hunch is gold is lying this time around. It's going to have a flush down of its own. And indeed, today we got a flush down, back again below 1842. And my hunch will see more declines for gold here. On the other hand, we're going to see more gains for the dollar. If that is the case, crude oil, in this case Brent oil, UK oil daily chart will have a hard time rallying. But we have two important numbers to keep in mind. 85, which is my number, and then 77, which is Fibonacci's number. I say closing below 85 for the week, not a good look for energy. But do we short? We have to keep an open mind. We're not going to short until we have a weekly closing below 77. And then this marks the beginning of the shorting signals, at least for the small caps / the high beta names in the energy cohort. But one thing I might be looking for is, what is the resiliency of oil? In other words, let's say the dollar continues to move higher, yet oil holds ground, and it doesn't lose 77 as support. Matter of fact, it might move higher. That would tell us right away that instead of shorting energy, we should actually be adding energy to our long exposure, because if the dollar finally stops, and it's going to stop at some point and move down again, energy is going to explode higher again, because the relative outperformance, when energy moves higher, yet the dollar is also moving higher, it is a sign for strength. And by the way, the same could be said about gold, because gold has been rallying, at least so far, as the dollar continues to move higher. Not today, but at least in the last few days. What does that say? At some point, when the dollar stops moving higher, when it becomes, let's say, overbought on the charts, you're gonna go long gold because it showed this important indicator, which is relative outperformance. When it comes to Brent oil in this chart, the daily chart, we can look at this as a bear flag pattern. And if it does play out, down we go and the support of 77 is gone. But the bulls can look at this as not all hope is gone. Because if this holds at 77 right now, we might have a pattern of higher lows. And little by little, oil is going to climb its way higher again. Decisive week for UK oil, in this case Brent oil. Now, what about the daily chart for the 10-year yield? Are we seeing the reverse head and shoulder formation playing out? The answer is perhaps. For now, it appears as it is working out as expected. A big down day in the next few days, and we see yields at 3.6, for example, 3.65, then no reverse head and shoulder formation. If that is the case, then you go along the TLT. But for now, too premature. For now, I think we have to wait. Even though the TLT was higher today, it is still below 103.5. We need to see a break. We need to see yields moving down, losing an important support such as 3.5. Before we say decisively that we should go along the TLT. The VIX 4 hours chart, what do we see here? We got a pop higher. It went down, not closing the gap exactly, and then we have a rebound at the end of the day. Can we read into it a lot and make mistakes? The answer is we could. For example, we could look at this as an ABC pattern, and higher we go. Sooner or later, the VIX cracks above 24.29. But we could also look at it this way. Instead, a reverse ABC pattern. The chart popped higher, the bull flag played out, got rejected, sold right away, and now we have a reflex, the B leg, and down we go in the C leg all the way down to 20. And if this is a telltale for anything, it tells us that we should not make major trading decisions right now, because we still have a market in consolidation within support and resistance, including the VIX, and it could go either way. So we have to look at perhaps longer range, more decisive charts, more important charts, in this case, the daily chart for the VIX. And if we do this, we're seeing a pattern of higher lows and lower highs, a triangular consolidation pattern. And we can look at this as, oh, the VIX broke above the consolidation pattern, and it is doing the classic you break above an important pattern, you go down in a retest and pop higher again. If that is the case, higher we go in the VIX, down we go in the SPY. So we have indicators that maybe the charts are favoring the bears, but they're not decisive yet. Apple 15 minutes chart, what do we see here? Yesterday, we talked about the important support of the gap. It was holding over and over and over again. Today, the chart closed below this gap, but is it a decisive closing? The answer is not really. So you can say, hey, Maverick, you're wrong. The support is gone from Apple. It was a sign that it's going to crack below it. You might be right at the end of the day, and I might be wrong, but it is too early to say. You short Apple today by the end. Tomorrow, it pops higher. You eat a pie in the face. A nice warm one. So why not wait for a decisive break one way or the other? Because this support number, by the way, fluctuates from analyst to analyst, from a chart to chart. And you could still argue that Apple did not lose this important support. And perhaps to be conservative, you might be looking at 124 to be broken before we say for sure that Apple is going to go down right now. We know it's going to go down for this year, but is it going to happen now? Is it going to happen after a rally? Is it going to happen right away? This is what the market is trying to figure out. Another way we can look at the chart is we have a pattern of lower highs. We have a sloping line of resistance, and the chart is pulling away from this line. This is a bearish outlook, but is it decisive yet? The answer is not quite. We could see another retest to this line, and it could be met with success. You never know. Tesla, 15 minutes chart, look at this. Yesterday, we talked about a bull flag pattern, perhaps a retest of 118.5. What do we get today? Pies in the face right away. The chart goes down, forming a bear flag pattern instead. The problem with this is you could short today and say, Maverick, you're wrong. Tesla goes down. And next thing you know, you wake up in the morning with a nice pie in the face because Tesla's up again. This is the danger in the market in consolidation. We see ups and downs. We see false patterns across the board. So you cannot make decisive trades one way or the other. We are now limited to day trades. We have no other choice because the market did not make up its mind yet. Yet here's the thing with TSLA. It continues to keep higher lows, at least for now, looking at the 15 minutes chart. So the chart is not saying one way or the other where Tesla is going to go. So we have to go back to a more significant chart, in this case, the daily chart. And what do we see here? We have a curve pattern that acts as a wall. The chart cannot crack above this curve at all, over and over and over and over again, until recently. It did. And yes, it's down since, but it's out of an important resistance pattern, a curve pattern. We see the RSI in positive divergence. We see Tesla now making a new low. We see the MACD indicator firming up, about to cross to produce positive impressions on Instagram. Now, if you want to short a chart that looks like this, have at it, my friends. But I'm not going to do that. I short charts when nobody wants to short them, when they're at the top. But when the chart is broken like this and it's oversold and we see signs for life, such as the positive divergence in the RSI, the MACD, the chart breaking out of the pattern in a gap higher, these are classic signs that this guy's going to pop higher. And I'd rather be on the opposite side, buying calls right now, rather than betting this is going to go down. Sure, the timing is challenging, to say the least, and therefore it is imperative that if you're going to buy calls in Tesla, to give yourself a little bit of time. For example, I rolled out to February instead of January because time is kind of running out for the January expiration. And last but not least, Bitcoin tulips, daily chart, no update here. Not moving one way or the other. If Bitcoin pops, it will be a sign for risk on. So we can look at Bitcoin as a leading indicator because it has been consolidating for a little while. And now we're seeing the market doing the same and consolidating too. So if we have a breakout in Bitcoin one way or the other, it could be a leading indicator to what's about to happen in the Qs, for example. And here is the bonus chart for UNH. We're using a weekly chart here. It has been an outperformer last year. Everything was down. UNH was up. And it was keeping an important trend line. Now, so far this week, the trend has been broken, but we don't have a weekly closing yet. If it closes the week this way, it is an indicator that UNH is a major short this year. We talked about the fundamental case with the layoffs. You don't need to insure employees anymore. But the technical case also suggests that UNH will go down this year. How down can it go? We have to use Fibonacci's help, and we have 470.5. Let's use that one as the next support. Probably that's not going to hold. And down we go to 416.5 as the next support. In the meantime, if you look at the daily chart for UNH, it is getting really, really oversold. So I'm not going to be surprised if I see a pop higher in UNH short covering, profit taking, but then it goes down again. So the timing is important. Maybe you want to go with calls in the short run, and then after the bounce is over, you switch to puts and you take it all the way down to at least 416.5. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the most important non-farm payrolls. I mean, it's a cooked number, but the market thinks it's important. And then we have the ISM Services Index and factory orders, along with a bunch of Fed zombies speaking insider traders. Who cares? With that, folks, this is all I got for you for tonight. Thank you for listening, thank you for watching, and I will talk to you again over the weekend. Good night.
Mr. Bingham, I'm here today to inform you that your position is no longer available.
I'm fired.
Yes, you're fired.
Never say fired.
You've been let go.